Hi everybody, welcome back to my channel. If you're new here, I'm Joseph Ranola, your go-to real estate professional on Staten Island. So today I want to get into mortgages, a quick deep dive into mortgages, right? This is the Start Here video series, so I like to encompass kind of all of the beginner topics that you would have to go through with, buying or selling a house. So mortgages, I'm not a mortgage broker. I can't give you full like mortgage advisement and all that stuff, but I am a real estate broker and I have to have a general knowledge of the mortgage market, of mortgage knowledge, and I can give some guidance and whatnot, but obviously you would have to consult a actual mortgage professional for mortgages and running numbers and all that stuff when it comes to that stage for you. However, again, I have to have a general knowledge of it. Let me give you some tips and tricks and just kind of what a mortgage is, and how it's going to help you, how there's different choices, what you could maybe look for, what might be good in your scenario. So yeah, let's get into it. If you or anyone you know is currently looking for a home and going through this process, send this video to them. This might clear up some stuff for them and help them out. So, okay, let's get into it. I do have show notes because it's, a somewhat long video, so I just want to make sure I don't miss anything. So, okay, mortgages, they can be confusing, right? I mean, especially with all the different terms and options out there, and you hear nothing but the mortgage rates. What's the rate? What's the rate? What's going on with, you know, there's just so much going on with mortgages. We're going to break it down. We're going to make it easy. So, first up, let's talk about the main types of mortgages that you will encounter. The one that you will always see, a fixed rate mortgage, right? That's the one where it's the most common. The interest rate is the same for the entire length of the loan. So whether you're taking out a 15-year mortgage, a 30-year mortgage, a 20-year, a different time frame, the most common is 30 years, but no matter how long it's for, the interest rate will not change. So if you locked in, let's say in 2021, you locked in a 3% or a 2.5% or whatever, for the next 30 years, you have that interest rate. Today, if you lock in a 6.5% interest rate for the next 30 years, you will have, or 15 years or whatever, you will have that interest rate. Now, can it go lower? Not with what you currently have. If, let's say, you lock in a 6.5% interest rate today, and in 3 years, rates are back in the fours or the fives or whatever. They're lower, right? Let's say they're considerably lower. You would refinance into a new loan at that rate. So let's just say you have 6.5. In 2027, the rates are kind of bouncing around between 4 and 5. You speak to a mortgage lender, you're able to secure a 4.5. You can refinance into that 4.5. Now, you might go back into a brand new 30-year one. So now you have a 4.5% interest rate, but now it's for 30 more years. Or maybe at that point, things are different for you. Maybe you go into a 15-year loan, so you just shaved all that time off. Whatever it is, that new loan will now have that rate. So 4.5% for the next 15, 20, 30 years. So that's fixed rate. That is the most common. That's what you'll most typically deal with. It's great for, your average buyer, right? Your normal person that's looking for a house that, yeah, listen, I'm going to be here for 5 to 10 years, 20 years. That's your person going for your conventional fixed rate mortgage. Now, next up is an adjustable rate mortgage. You've heard a lot about these in the last year or two since the rate started to run up, right? You would see, oh yeah, get an ARM, right? Adjustable rate mortgage is ARM is short for that. So you would see, yeah, get an ARM. It'll be 5.5, the first couple of years, and then it'll go up. So yes, adjustable rate mortgage will have a period of a fixed rate, right? So it could be 5 years, 7 years, 10 years, which would be pretty good. The average person moves every 7 years. But however, if you truly are going somewhere, it's going to be a couple of years, 3 years, 5 years, 7 years, whatever it is, it's not permanent. An ARM mortgage could be something worth looking into. So again, it's going to have that first set of time, the first couple of years are fixed, but then annually It will adjust based on current market conditions. Now, there are limits to how much it could rise at in any one given year, because you can't go from, let's say you start your arm at 5.5, and then the 5 years runs out. It's not going to jump up to 9%. There are limits. Again, consult a mortgage lender for the exact particulars with all that. But it can go up, it can go down. Will it ever go down? I don't know about that, but it can and most likely will go up, to that certain degree every year. So it's something that brings uncertainty with it, right? Like if you're looking at a forever home, I'm not going with an ARM mortgage. And again, there's strategies, right? Everyone's thinking a few years. Look, these 7% rates, they're not going to stay here forever. Doing ARM right now, and then they're going to drop in 2 years, 3 years, 4 years. So you got to enjoy all that saved interest, and now you could refi into a fixed rate. Listen, there's strategies. There's different things you could do. It depends on your risk tolerance, right? Because nobody knows next year, next month, 10 years from now what the rates will be. Yes, you have historical data to go off of, right? Rates do this, do that, whatever. But that doesn't mean anything. It doesn't mean that rates will go down. It doesn't mean they will go up. It doesn't mean anything. So again, an ARM is maybe for somebody looking for something that is not permanent. But now the caveat to that is, what if you're in year 3 and this move does become permanent, and now you're nearing the end of your arm, and now you're stuck here, and God forbid the rates do start to fly up. Are you going to be able to afford the yearly increases? It's definitely, there's uncertainty with arms, so just be careful with them. But it can definitely be a viable option to save you some money. It just depends on your situation. Then you have FHA loans, right? These are insured by the Federal Housing Administration. They're ideal for first-time buyers, those with lower credit scores. They offer lower down payments, sometimes as low as 3.5%, 5%. Those are very common with those. They're more lenient, right, with their approvals, but then they're also more stringent, typically, with their appraisals. So if you go for an FHA loan, right, let's just say you're buying your first house, you have that 3.5% down payment. That's all great. Now we're going through the deal, right? We did the home inspection. We did all this stuff. We're going to contract. Now, when they send their FHA appraiser out, he's going to be much more stringent on problems, what the problems that he sees with the house, where maybe a conventional mortgage may not have had an issue with the cracked window in the front, or whatever other issues, a problem with a staircase, a banister, electrical panel, whatever it is. Conventional may have, but may not have had an issue with those things. FHA most likely will. And now we're at a problem where these things need to be fixed before closing. Typically, right, a first-time home buyer, you're not flushed with cash. You're sick to your stomach. You're making this huge purchase. You're already spending every dollar you have to buy the thing. So are you able to now go out and spend, let's just say, $5,000 on repairs just to buy the house? So who is it going to fall on? The seller, typically, right? So sometimes sellers could be weary of an FHA loan, but overall, it's a great program. It's great that it helps those that are starting out, or maybe have lower credit scores or whatever. Next up, number 4, you have VA loans. These are available to veterans. Very special thing. They're very deserving of it. Absolutely, they should have something like this. So this type of loan gives competitive interest rates, no down payment, and no PMI, right? Private mortgage insurance. So typically when you put down less than 20%, until you reach that threshold of having 20% equity in the house, which, how do you get there? Just from your monthly mortgage payments, right? It might take 5 years, 3 years, 10 years, whatever, to get to 20%. But then you could reappraise the house, and now you could take that PMI off. The VA loans with 0% down payment. So you have pretty much no equity in the house when you're buying it. They don't charge you that monthly PMI, which is pretty cool. Now, VA loans, like an FHA loan, very stringent on the home appraisal that the bank will send out. And why? It's because the bank is putting up potentially 100% of their money. So they need to protect themselves. It's understandable, but definitely great way to go. If you are a veteran, thank you for your service. Let's talk. You definitely deserve a nice VA loan. It's a great way to get into some properties. There are USDA loans. These are popular in rural areas. It's not something we'll really ever use here in Staten Island, New York City. really anywhere near us, right? We don't have any rural land, so we won't really get into those. That's out of the scope of what we deal with. So let's break down some key mortgage terms, right? So principal. Principal is the amount that you borrow to purchase your home. So let's just say the house is 500,000, you're putting down $20,000. So your principal, the amount that you owe on this house is $480,000. So the second part of that, that's always tacked to the principal, of course, is the interest. So that's the cost to borrow the principal, right? So, and that's broken down in a percentage rate, right? So your interest is 7%, 4%, 8%, whatever it is. So the way it works is every month you're paying pretty much four things, which I'll touch on that in a minute too. But your mortgage payment is really your principal, your interest, your taxes, and your insurance all rolled into one, because they all have to be paid every month in regards to your house. So it's those four things together. But now the principal and interest are interesting, because even though your payment will never go up, now asterisk, right? Your mortgage payment will go up over time, but that's only because of the taxes. If the taxes go up, again, your mortgage payment is broken up into four parts. The fourth part, your taxes, that's the only, well, and the insurance too, but homeowners insurance, lately it's going through the roof and everything, but typically that's more stable. Your taxes typically, right, up every year. So you will have slight increases on your mortgage payment because of taxes, possibly insurance. But the principal and interest are always, it's the same overall amount. But what's cool about it is, as time goes on, you pay more of your principal and less towards interest. So the bank, right, they front load the payments with interest, right? Because they just put out, $400,000 for you to get a house, right? So they need to get some of their money back. So even though your payment, again, forget about taxes and insurance. Let's just say your mortgage payment is $2,000. Even though it's going to be $2,000 no matter what, in the beginning, the first year, the first 3 years, the first 5 years, you might be paying $1,500 of that, $1,300 of that in interest. So only $500, $600, $700 of that is going towards your actual principal, the actual amount that you owe. So you owe $480,000. This month you made a $2,000 mortgage payment. You might have only put $500 towards the 480, right? But again, they front load it because they got to get some of their money back. But as time goes on, as you keep making your payments, if you can make extra payments, if you can make just a little bit more, if your mortgage payment is $2,000 a month, pay $2,200 a month towards it, because that extra $200 goes straight to principal. So yeah, it'll kind of like interest, principal. It goes like this throughout time, where by the time you hit year 7, year 10, year 12, year 25, you're paying maybe 80% of that in principal, 90%, right? 70, 80, 90. So that's just an interesting thing that not a lot of people realize with all of your mortgage payments, that you got to make 360 of them if you do a 30-year, right? So amortization is the process of paying off the loan over time. Again, that's kind of what I just explained with, that's kind of like your growing proportion of your principal and your interest and all that. That's just so you're aware of it, because you'll hear it when you're going through the process. That's amortization. Escrow, you'll hear this word thrown around a lot. It's an account that's held by a third party. So when you pay your taxes, again, it's four pieces, right? Principal, interest, insurance, taxes. This half, insurance and taxes, that is being held in escrow by your mortgage company. So you're paying them the whole thing. They're taking that half, putting it aside in an escrow account, and then that pays your insurance and your taxes. So nothing you really have to worry about. A nice thing is that they are not allowed to hold extra money. So annually, you'll typically get like a check back within like an overage in your escrow account, because they're not allowed to just hold your money. So they, throughout the year, they keep a little extra in case your insurance or your taxes go up. But once a whole year goes by, hey, wow, you have an extra $700 sitting in your escrow account. We got to clear that back out to zero. You get a $700 check in the mail, $300, $400, $1,000, whatever. So nice little touch. So that's that. I wanted to, again, briefly touch on mortgages, the terms, little tips and tricks. Again, one more trick I didn't bring up before. So remember I said, if you can, think of it as a forced savings plan, right? You have to pay your mortgage every month. And it's like you're saving money, because you're lowering the amount that you owe on this asset that you could sell for a certain amount of money. So obviously the lower that you owe on it, the more you get when you sell it. So instead of just paying once per month, like, every fifth of the month, let's just say your mortgage payment comes out, I would split it up bi-weekly where you're paying every other week, because that gets an extra two half payments a year because there's 52 weeks, right? Split that in two, that's 26. So you're getting one full extra payment a year towards your mortgage that goes straight to principal. That could shave years off of your loan, and it could shave, a ton of interest, right? Because you're looking at your mortgage, right? Your mortgage is, again, 480,000. That's your mortgage, but what you're paying over the life of your loan, if you don't pay it off early at all, you'll probably be paying with the interest added onto it 800,000, 900,000 over the 30 years if you don't pay it off early. So that's that. Again, send this to somebody. Send this to somebody going through it. Help them, listen, spend 15, 20 minutes of your time, and you just kind of arm yourself, right? Arm yourself with some knowledge. Please subscribe, like, comment. Please put your comments in there. Let's discuss. And again, share this with someone that you think it may be beneficial to. For more insights, updates on the Staten Island market, follow me. Instagram, everywhere. I'm Ranola Real Estate. So give me a follow and keep in touch. Let me know if there's anything you want me to talk about in the next video. Thank you, guys.